Hey everybody, good to be here today. My name is Brent Moore. It's time for our weekly session of Advanced Option Strategies. Today I want to talk about various means of trying to protect your portfolio, protect both stock positions and option positions. So we're going to hit up that in just a little bit. I'm joined alongside Barb Armstrong, who's helping me out in the chat today. I always appreciate Barb. And you can follow Barb on X. You can follow me on X as well, at Brent Moore CS, at Barb Armstrong CS. For additional content there. Let me just go through some disclosures here. Happy New Year to you all. This is the first class of this series this year, and hope you all had a good New Year. Options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only and should not be considered an individual recommendation or endorsement of any particular security chart pattern or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. The paper on money application we're going to be going through today is for educational purposes only. And for the sake of simplicity, I may not factor in commissions on every trade, but just realize those are real and pay attention to those. All investing involves risk, including risk of loss. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount, and there's no guarantee an execution of a stop order will be at or near the stop price. And with a stop limit order, you risk missing the market altogether. So there's our initial disclosures there, but let's take a look at the markets because I want to just talk about something here. The market had a really strong year in 2024. It had a pretty strong year in 2023 as well. So we've had a big run up, and you get periodic pullbacks. And if you listen to the financial news, and this is not a prediction, I don't know what the market's going to do, but if you listen to financial news, you're going to hear a lot of people talk about market valuations. Now we've had even from the high we had recently, and it may be a little disappointing during the Christmas season, we didn't really get that Santa Claus rally really. The pullback was only about 3% there. 10% pullbacks are very common. Most years have something akin to a 10% pullback. 20% pullbacks, maybe not every year, but they occur occasionally. So it gets people thinking about the markets pulling back. I don't know whether it's going to, but I want you to be prepared with strategies for your portfolio, for particular stocks, for particular options to help try and protect yourself in this case. Additionally, we have earnings season right around the corner. Just a couple weeks, actually probably less, I think, before we start to hit the major earnings here. So that's coming up. In fact, if you want to see earnings, you can always go to the market watch. You can go to calendar. Here's earnings. Now you see a lot of stocks, but this is every stock. Make sure you narrow it down a little bit. If you click here, click on the little gear, go to public, and you can narrow down to that S&P 500 or even the S&P 100. Let's see. Here's the S&P 100. So now these stocks are going to be bigger name stocks that you're going to be familiar with more than likely. And you can see January 15th is really where we kick off here. So that's, I don't know, 12 days away. And so obviously, there's uncertainty with earnings. Perhaps, just perhaps, there's a stock that you have in your portfolio and earnings is coming up and you will go, I'm a little worried about this. Maybe I don't want to sell my stock, but I want to hold on to it, but I want to help protect myself. We're going to talk about that a little bit here because we're going to be talking about callers and protective puts here today. Now, when we talk about options, let me go back here, and I'm just going to remember there's 4 basic types of options. I know some of you are newer with me today, and this is an intermediate level class, folks. So I'm assuming you know some of the basics of options at this point. If not, we do have a getting started with options class that occurs on Tuesdays there at noon Eastern time. But there are 4 basic option trades: a long call, a short call, a long put, and a short put. All right. Now, you go, well, I hear about all these different strategies. All these different strategies are built with these four basic types of trades. Okay. An analogy I like to make is, think of your DNA. You've got four types of nucleic acids there. They build up all of life there. All these different structures can be built based on this building block of this pattern of four. Same thing here. Long calls, short calls, long puts, short puts. When you hear about butterfly spreads, calendar spreads, iron condors, they're all built just different variant combinations of these different types of trades. Now, long calls, something I want you to remember that you likely know, is they have a positive delta. They're bullish. Theta, time is negative. Time decay is working against you on these, on that. In fact, let me do this. Instead of putting those symbols down, I'm just going to type in positive. I'm going to type in negative for theta. What about vega here? What's our vega on a long call? Our vega is positive. In other words, if implied volatilities go up, it tends to help out our long call. What about with the short call? A short call, negative delta. We're bearish on that. And this is going to be important because when we talk about protecting our portfolio, we're going to use different things here, different elements of here to try and help protect your portfolio. Hoping that's making sense there. Theta on a short call is positive. Time decay actually helps us out on that. Vega is going to be negative. Now, I want you to notice this relationship between theta and vega here. Notice they're opposite. Theta is negative, vega is positive. Theta is positive, vega is negative. On all these trades, that's going to be the case. Now, long put, delta, negative. It's a bearish trade. Long put, theta is going to be negative. Time decay is going to work against us. Vega is going to be positive. Let's go through the last one here. Short put, it's a bullish trade. Delta is positive. Theta is positive. Time decay helps us out on that trade. And vega is negative on that. In other words, if implied volatilities go up, that hurts us. That's our negative vega on there. Now, with these in mind here, what I want you to consider is this. If we're trying to protect a stock here, let's say you have a stock, I don't care what stock it is, there's different means to try to hedge or protect that stock. Let's talk about some of those. One, sometimes I hear people proposing doing a covered call to try and protect your stock from the downside. But let me tell you this, folks. A covered call does not offer significant protection. It really doesn't. You bring in a small premium on there, emphasis on the word small, but it really doesn't help you that much on the downside there. So what I'm going to say is, for protection, ixnay on the covered call. That is not offering much substantial protection there. Okay. What about a short put? If you sell a put, does that offer protection? No, that actually increases the I said covered stock, that should have said covered call. If I do a short put, does that help? No, that actually hurts you in terms of your protection. You're agreeing to buy more stock. You're doubling down on your risk. Now, let me just mention this. I appreciate all you watching today, especially all those from Dallas. The Dallas workshop is chiming in. There's, I think, 700 of them or so, of 700 wonderful souls joining us from that Dallas workshop today. And you know what? This is an advanced options workshop. We have a whole variety of different workshops, and I invite each of you, whether you're in Dallas or not, to check out our other workshop schedule to try and help you, to try and assist you, take you to the next step after getting all the good stuff that Ben is teaching you and Scott and Ray. Love those guys. And continue your journey with the on the Trader Talks channel there on YouTube. Okay, everybody? All right. So we've talked about a couple means that are not protection on your portfolio. Not protection. But let's talk about some things that are more protective, maybe helping you to protect the portfolio. You know, one choice that you always have is this. If you have a stock and you're thinking, how am I going to protect this stock? One choice you always have is you can have the choice to sell your stock. Okay? You get out of your stock and then you don't have to worry about it. Now, there's no upside at that point if you continue to hold on to that stock, of course. But if that's going to help you sleep at night and if that's what you need to do for your portfolio management, that actually is a possibility, and I want you to consider it. Sometimes we think of trying to think of all these various ways to protect ourselves. Sometimes selling a stock may be just what you want to do. You take the profit, or maybe you're at a loss. Sometimes you just kind of you lick your wound, so to speak, and get out and cut those losses. There's another way of protecting a portfolio, and that's what we'd call a protective put. Okay, it's supposed to be an E, protective put, and that is you're buying a long put. You're buying a put on stock that you own. And here's what happens with that. There's a good thing that can happen with that. Number one, it can actually offer you pretty good protection if the stock drops down a lot. It's not going to absolve you of all potential losses. But what it does do is as the stock goes down, you know what happens? That long put, the delta gets more and more in terms of absolute value. It gets higher. In other words, it helps protect you more and more if the stock goes down more and more. Now, there's a downside to that. And the downside is, remember, the long put, what's our theta on that? Our theta is negative. So time decay is working against us. So if the stock is not helping us out, then that's not, if the stock goes up, for example, which is great, we want the stock to go up, that long put, we're going to be losing money on that long put. So let's take an example of that. How about, okay? So in this portfolio that we have, I've got Delta Airlines, and I have we've had some gains on Delta. And so one choice I have to do on this is I could say, hey, look, the trend has been going up. It looks like that trend may be reversing itself. Do you guys see that? Here was my trend. If I were to draw a trend line here on this, what happened to our trend? We have a broken trend. Exiting the trade is certainly a possibility, but there may be times that you don't want to exit that trade. And in that case, maybe you consider adding a long put in case this trend continues down. We have a high, we have a lower high, we have a low, we have a lower low. That is actually a reversal of trend. So certainly you could just look to exit the trade. That's something I mentioned earlier as a possibility. But instead, one thing we can do is we can look to buy that put. Okay, on there. We also have earnings coming up on this, right? So that if it goes down a lot on earnings, that's on the 10th. That's coming up. So let's go and let's just look at a put. When you're deciding what put to buy, consider how much you want to protect yourself. Consider how much time. I certainly want it past earnings. Maybe though, if in another, say 3 weeks, if this trend has not reversed itself, we say, we're just going to get out of this, but I want to protect myself for those 3 weeks. Therefore, what I'm going to do is I'm going to go out at least the time frame I say. We'll go to January 21st. I'm going to look at my puts. Puts are on the right side of the page. I'm going to consider that delta. Very often we'll look somewhere in the ballpark of maybe a 30 delta or so for our protection. Now there's benefits to you. That's not a, there's different, you can choose different deltas. If I do this higher delta, great, more protection, but it's also going to cost me more, almost $300 for it. If I go down to here, say the 33 delta, it's going to cost almost half that much. And remember, that delta is going to go up in terms of absolute value at least, okay, if the stock drops. So it's going to offer more and more protection as we go. Someone in the chat, George, said, gamma accelerates that delta. That is true. Gamma will accelerate that delta as the stock moves. So I'm going to stick with what I said. I'm going to stick somewhere in the ballpark of that 30 delta. And what I'm going to do is I'm just going to buy the put here, and that's going to help me on the downside. Now, this would be for 100 shares of stock, which I think I have. I've got 150. So I'm going to call 100 good enough, one contract. And I'm going to look to buy this. Natural price is 168, mid price is 161. I may be able to get in a little bit cheaper than that natural price. I'm going to knock it down just a little bit here, and I'm going to confirm and send, and then I'm going to send that order. Okay. Now, so Chris asked a great question. I don't have a perfect answer for you there, Chris. So Chris in the chat said, hey, look, we've got earnings coming up. Is there if you're just protecting yourself just because of earnings, okay, if you're just protecting yourself just because of earnings, is there a sweet spot of when to buy before earnings to protect yourself? Because remember, if you pull up the implied volatility, that implied volatility, the higher it is, the more that protection is going to cost. Very often before earnings, you see that implied volatility ramp up. You can see that here, and then tail off a little bit before earnings. You're going to look back at history and kind of see if that's the case. If you expect it to tail off, and again, we do seem to be tailing off a little bit, it benefits you to wait as long as you can before earnings here, before you actually buy that protection. But if historically that implied volatility goes all the way up to earnings, then maybe it would behoove you to buy it a little bit earlier. But a few days before earnings is certainly sufficient there, Chris, would be my take on that. Okay, Eleanor said, what makes a put short versus long? Now, folks, remember this. Remember, we have that Getting Started with Options class on Tuesdays to double check, to help you out on this. But a short put means you're selling that put up front. A long put means you're buying the put up front. Short put is a bullish strategy. Long put is a bearish strategy. So if we're trying to help ourselves, if the stock goes down, the assumption is we still own the stock, and that stock goes down further, then the long put would be the way to go on that to try and help hedge it. Now that's just buying the put there, okay? That's just buying the put. We just talked about just buying that put. What happens though if we do this? We have that negative delta, and this is a negative delta as well. Short call and long put are both negative deltas. Now, I said this long put offers some protection, but what if we were to do this? What if we were to do both of these at the same time? You sell a call and you buy a put. The delta of those two together will likely equal something in the ballpark of 1. Now remember, the delta on our stock is 100 shares of stock, that is about 1 or 100 for 100 shares. So we could say 100 or 100. So my deltas together are going to offer me more protection by doing these both together. Okay, by doing these both together. But here's a little extra benefit. Remember I said one of the downsides on that long put was that it was a negative theta. Time decay worked against us. Look at the short call though. We have positive theta. They mostly cancel each other out. Okay? We may be net negative or net positive just a little bit, but basically your theta is going to be almost reduced to nothing. So it doesn't hurt you if the stock just kind of goes sideways. Same with Vega. They largely cancel each other out. So therefore, why don't we just always do both of these together? And both these together, we're going to call a caller. Okay? Both of those together, we're going to call a caller. Why don't we always do those two together when we want to protect ourselves? And the answer is this, because you give up all the upside on the trade. So in other words, let's look at another trade here. Let's take a look at Goldman. Okay, here's Goldman. I've got 100 shares of Goldman here. Okay, I've got 100 shares of Goldman Sachs. And it's had a nice run, but again, maybe a little weakness here in this. Okay, little weakness here in this. And we've got earnings coming up. This is one of those financials on the 15th. That's what those financial stocks like JP Morgan, Bank of America, Goldman, those are the ones that like kick off earnings season, really, kind of the official earnings season. So we have that we're maybe a little bit concerned about. If you're willing to, if you want, we could do a caller on this to totally protect ourselves on this. Now, what happens if the stock does this on earnings and I have that caller? The answer is we will have missed out on those gains. Okay, so that's the downside of the caller. But if the stock goes sideways, that's fine. I'm not losing any money. Remember, theta is not going to hurt me. If the stock goes down, it's not going to hurt me because my deltas, my negative deltas, are going to cancel out the positive deltas on the stock itself. Okay, so let's look at this as a caller example here. So what I'm going to do is I'm going to go to trade. I've got Goldman. Again, pick the time period that you want. I can go, if I want, I could go earlier. I can go to January 17th because I have earnings on the 15th, I think. Was I right on that? 15th? Yeah, earnings are on the 15th. So I can go here. I could buy a put. So I'm going to do that. I'm going to go in the money just a little bit on this put. And we'll go to 575 put. I'm going to buy that put. Let me just shrink that down. And I'm going to hold down my control key on this. And I'm going to sell a call on this. And I'm going to hold down my control key when I click on the bid price here. My net cost of this is actually a credit, about $100 credit on this one here. Okay? About $100 credit on this. Our theta and our theta and our Vega are going to be largely neutralized. And I'm going to go and I'm going to just send this order here. Let me just go. I'm going to go just a little bit, try and ensure that we get filled on this. Goldman. So we just filled on that. Now, let's look at our monitor tab for Goldman. Okay. So our deltas. Let's consider our deltas here. Okay. Let's consider our deltas. 100 shares of stock gives us 100 deltas. The two option trades are both negative deltas. So 47 plus 44 is like negative 92 on my delta there. And so that is, I think I get my math right there. In other words, our net delta is now positive 8, very little. So if the stock goes down, it's not going to harm us nearly as much. Our theta, our net theta, these two largely cancel each other out. We're actually slightly positive theta. Time decay is actually going to help us out on that a little bit. And vega largely canceled out as well. In other words, we're just kind of putting a freeze on Goldman Sachs right now for us to get through earnings. And then once we get past that and we're comfortable with it and we can then look to exit these trades when we want to here. Okay? Now, let me erase that. And let me just address questions. Debbie says, strike choices. So the strikes don't make a huge difference on this, but let's look at what the strikes I could have done. I could have done certainly just 580 and 580, 580 strike and 580 strike. They largely would have been done the same thing. If I want it totally neutral, you can just go at the money. Our stock's at 578. Oh, I guess there's a 577.50. So I guess technically the 577.50 is the at the money contract. But one thing I noticed was if I sell the call and I buy the put, they're not the same price exactly, right? Now, it doesn't matter. They don't need to be exactly the same price. And ultimately what I chose wasn't the same price. But if I'm buying that put at $13.35 and I'm selling the call at $14.90, then that is actually going to be a little bit bigger credit. So often what I'll do is I'll try and get a pretty similar costing item here so that they largely offset each other on that. But typically we're going to go near the money on those. And usually I'll just go out of the money just a smidge on both of those there. So and George said something, I know this is a different conversation, but I'm trying largely to cancel out the 100 deltas of the long stock by having the sum of these deltas be pretty close to 100. So I wouldn't worry about it if you go up or down a strike or two on those. Okay, let's go on and let's go to another one. Let me just double check time. I think we're doing okay on time. Let's do another one. Here's American Express. Okay, again, we have a nice trend here. We have when's earnings? Well, I don't know when exactly. Earnings is probably it's probably coming up. It's probably just off the screen just a little bit here. So earnings will be coming up on that. We've had a nice run on this one there. So there's the run that we've had. But if I want to protect myself, I may do a collar on this. And I can do that. Again, I'm going to go to the trade. I'll go out a little further on this one. I'll go out of past earnings. Let me just double check when earnings is. American Express, January 24th is earnings on that guy. So I want to go out past January 24th. That's earnings day. Just to be safe, I'm going to go out a little bit further here. Okay, I'm going to buy the put. Again, if I go right at the money here, my prices are quite different on those. So I may buy this put and sell this call right here. I'm going to buy that. I'm going to hold down my control key, sell this. Now look what happens. let me confirm and send this real quick. And I want to show you AXP on that Analyze tab. Okay. And yes, I will cancel my stop loss. Chris is asking, should we cancel a stop first? And the answer is yeah, because this is an alternative. We'll talk about stops in just a little bit, but this is kind of an alternative to that, because if the purpose of the stop loss is to help protect ourselves if the stock drops, even though stops aren't guaranteed, that's the purpose. This itself is here to protect ourselves from that here. So let me get rid of, let's see, we just filled those. Let me get rid of that and that. Okay. And there's my trade. Something is not showing correctly on this. January 31st, that's today. I have an extra trade in here or something. Something's not showing right on this, and I'm not sure. Huh. 100 shares. Yeah, I'm not sure why that's not showing right. I have to play with that. I don't want to take our class time to play with that right here. Basically, what I wanted to show you was them just canceling each other out. My net delta on American Express right now is, let me cancel that stop. Per Chris, thank you on that. No need for that stop on there. But my net delta on this is going to be the 100 minus the 48 minus the 43 is going to be a very small delta to try and protect us. Those are callers, folks. Remember, callers are kind of the ultimate protection, but you're also giving up the upside on those if you do that. Now, there are other choices. Let me go to AIG for a sec. Let's look at AIG. I'm not going to do a caller on this. This is a stock that just has not been performing well. I'm down on this. I'm down $300 on this right now. And the question is, do I stick with this? Well, I don't know. I was hoping for something more bullish. It's not happening. I do not have a stop. I do not have a stop on here. That's what my next step is going to do, is I'm going to actually add a stop. Now, remember, stops don't guarantee that I'm going to, stops don't guarantee we're going to get out wherever our stop was. But if I still want to take advantage of the upside, if I still want to be in this trade for now, then what I want to consider doing is a stop. So I'm going to put a stop in below our most recent bounce, which was, we hit a low about 72. I'm going to go below that a little bit. I'm going to put a stop in here around $71. To add a stop, I'm going to go to my trade. I'm just going to right click on it. I'm going to create a closing order. I'm going to sell it. I'm going to change this to a stop loss, put in my appropriate price here. We said $71. I'm going to make that good till canceled. And I'm going to confirm and send that order. There we have a stop. Because stops aren't guaranteed, let's say AIG has a terrible earnings or something, and AIG goes down to, I don't know, $50 or something like that. It gaps down. The fact that I have a stop here is not going to do me any good on that, probably, because it'd probably trigger around $50. But if I had a caller or if I had a protective put, they would do me a bunch of good in that case, because those would go up in price if the stock dropped down. I use kind of an extreme example at $50 here, but even if it gaps down to 67, Is that a realistic drop? Yeah, that happens all the time when a company has earnings. They're more likely to protect me in that regard. All right. Now, there are other approaches to trying to protect yourself with options. You could do a short synthetic. I'm not going to do that right now. Okay. You could do a short synthetic. You could, and remember the first choice, not first choice, I don't mean by first best, but first thing to maybe consider is just selling your stock there. But I also want to talk about hedging options trades here too today. But let me just double check questions here before I go to trying to protect options trades. Here, can I talk about long strangles on futures? I'm not going to talk about futures today. Okay, this is not a class we talk about futures on. And long strangles are a totally different trade than what our topic is today. So I'm not really going to go in this. I have talked about long strangles though in this class in the past. Go to the playlist for this class. Go back, I don't know, a month or two. If you look at the titles, just go to Trader Talks, go to the playlist in this class. I do have a session on long strangles there. Maybe, Barb, you can help me out and put the playlist for this class in the chat there for vasopressor. Okay. Let's see. Do you have to own a share when you use a caller? That's from Tony. Okay. You don't have to own the shares, but it kind of ceases to be a caller at that point. When we call it a caller, we kind of imply that you're owning that stock there. So the caller is equal to the short call, the long stock, and the long put. That's what we're going to call a caller. Okay. Could you just do a short call and a long put at the same time? You could, but generally we don't do that. And the reason is this. Do you see that short call? What if the stock went way up, the stock that you don't own in that scenario? That is what we call a naked call. You have theoretically unlimited risk on that short call. So that's why we don't typically do that without the long stock in there. Now, what if the stock goes up and you have the long stock there? Then the danger of the short call is being offset by the benefits of the long stock in that case. All right? So there we go. I'm hoping that makes sense there. That's a good question there. Now, let's say you have an option. Well, let's think of this. I have some options, and I need to go through this relatively quickly. But let's take a look at, we have Apple. On Apple, this is a call leap. Okay, this is a call leap. Long expiration, out a year basically from now. And it's been working out pretty well. But let's look at what Apple's been doing. Okay, Apple's been doing great. Apple's been doing great. But we've had a little pullback last week or so. Okay, fair enough. So it may make sense to put a stop on it. Look, I bought this call for $30. The expensive option, it's a leap. Leaps are expensive. Right now it's at 41. So we've made a nice little profit on this. But what I want to do is I want to protect this. So I'm going to add a stop on, and I'm going to put that stop about where my initial price was. So in other words, if Apple completely goes down against me, it's going to get me out so that more or less I won't have lost anything. Now, just as with stocks, stop losses on options are not guaranteed. Okay, but that is a way to protect a long option, is just to add a stop on there. So I'm going to sell this. I'm going to make this a stop. I'm going to make it good till canceled. And I'm going to make this, put this in at $31. Okay. Now, when I confirm and send this, I'm going to send that. And now on Apple, I've got a stop to try and help protect me on this. Okay. So that's one approach to do it. There's another approach you can do, though, on options. And let me go back here to kind of mention that. When you're trying to protect options, if you just have, for example, a long call, something that you could do would be, is if you just have a long call, you could add a short call to it, okay? If you add a short call at a higher strike price, so if we have a long call and we throw on a short call on there, we're bringing in a premium. Now, all of a sudden, the initial risk on that long call, which is your initial debit, the risk on your long call is your initial debit, the initial cost of that. You're bringing in a credit here that's going to help offset some of that. In the process, you've turned something from a long call into a long call vertical spread. You're capping your upside, but you're limiting your downside. Okay. Same thing if you just had, for example, a short call, a naked call, which I don't typically teach, but if you just had a short call, then you could add a long call on there. I could throw a long call at a higher strike price, and then that's transferring me from a naked call into a short call vertical, okay? That's offering a lot of protection there on that trade. Similarly, you could do the similar thing on a long put. If I have a long put, I could add a short put, okay, at a lower strike. Okay? It brings in a credit. It helps to offset some of that risk that we're taking on that. And those two together are going to make a long put vertical. And just for thoroughness, let me complete the last one. If I have a short put and I add on a long put onto that trade, I then have a short put vertical is the net result on that. And that is helping to hedge that trade. So you can hedge stocks, you can hedge options. We've given you examples today. We've talked about just exiting the trade. Just exit your stock trade, or maybe you exit the long put you happen to have on or something. Just close out is one possibility. Adding stop losses is another way to try and protect yourself, even though stops aren't guaranteed. Adding on a protective put on a stock may make sense for you. If you don't want to give up that upside for the stock, but you want to give yourself partial protection on the downside. Throwing on a collar is a way. If you're willing to give up all that upside, but to give you better protection there on that stock. And then if you have these option trades, you can always throw on kind of the opposite trade. Instead of long call, throw on a short call, or instead of short call, throw on a long call, as I illustrated over here, to try and help protect your trade. Okay. Oh, sorry, I wrote this wrong. This was supposed to be short put. Okay, this was supposed to say short put, not call. Thank you for calling me out on that, Howard. Appreciate that. This is supposed to be short put there. Remember, you can just add the opposite on. If you have long put, add on a short put to help hedge yourself, and vice versa. You're turning it into a spread. So those are all ways of potentially hedging your portfolio and trying to protect your portfolio. Everyone, thank you so much for joining me today. Coming up next, we have ThinkScript. I'll actually be teaching that class today. Thank you, Barb, for helping me out in chat. And I hope you all have a wonderful rest of the day, weekend ahead, and we'll see you all same time next week. Bye-bye, everybody.